Hello, I'm Anna Rathman, and I am the host of the Chamber Music Mindset and for the founder and CEO of Granadilla Advisory. We have a lot to talk about today with regards to the happenings of last week, as well as when to anticipate in the coming week. But before we start, I need to remind everyone that nothing in this video is investment advice and everything is for information purposes only. So what happened last week? It was actually a really exciting week in the markets. There was a lot of stuff going on, but the end performance didn't look, that eventful. Well, everything ended up in the positive territory. Okay, it might not have been an eventful week, but the markets were actually mostly negative for most of the week except Friday. It was really Friday that turned everything around. The markets were jittery, and this is my opinion. I believe because there's a lot happening last week, and everything was sort of leading up to Friday's 10 a.m. message from Chairman Powell. The Federal Reserve met in Jackson Hole, and they do this annually. They meet and they talk about various economic factors, and they have this they huddle together and they meet. And usually it ends with the chairman or chairwoman giving us an outlook of what the Fed thinks at this moment. There was a lot to be nervous about for the markets because the question is, will the Fed keep the rates the same in September or will they cut? And the markets were pricing in a huge probability, 80 to 90% of the Fed cutting rates by 25 basis points in September. But as we've talked about, there's been a lot of questions about, does the Fed follow the softening labor market data or does it follow some of the inflationary pressures that we're seeing from tariffs? Because PPI, remember, wasn't that great for the inflation portion of the Fed's dual mandate. So a lot to be jittery about, but also, whenever there's jitters in the markets or fears in the markets, usually the thing that gets hit very hard are the stocks that are very, very expensive, high valuations. And for the week, that happened to be anything that has tech in it, right? So Palantir, I know, took a huge dive. NVIDIA took a huge dive. NASDAQ basically led the major index, S&P 500, down by a huge amount. So it was a jittery week, but on Friday, Chairman Powell came out and basically opened the door for the 25 basis point cut in September. So of course the markets rallied. S&P ended the day, one-day performance of 1.5%. Here, I have some of the numbers here. NASDAQ was up almost 2% for the day, and small caps were up nearly 4% for the day. So Friday, or maybe Jerome Powell, ended up saving the week for the major indices here in the United States. The US dollar fell about 1% just on that day because of the anticipation of a rate cut. So a reminder, a lot of major economies and their central banks have been cutting rates because of the growth issues. The Fed has been the only one that's been kind of, hanging out. The Fed started cutting last fall, but then basically have been on a pause because of the uncertainty surrounding tariffs. So we'll see what happens in September, but the markets were very excited Friday. Okay, so what did the Fed or Chairman Powell say after the Jackson Hole meeting? Not only did he open the door for a cut, but these are the things that actually stood out to me from his communication. He said that there was a balanced risk to the outlook. When I heard that, I thought, okay, maybe the labor market and the inflation risks, they're saying that it's balanced. Okay, that's a fair statement. He also said that maximum employment is not measurable. That I took to mean he's taking a step back from looking at the labor market and thinking that it's softening. Right? So that's a little bit of a hawkish statement. But I think the most important thing that he talked about was this idea that the Fed may have to take a preemptive action, meaning it's not data dependent as we have come to know the Fed to be. Because remember, I said a few weeks ago, data, it's all backward looking. If you wait for the data to come out, it's a picture of the economy from like 3 or 4 months ago, and you're making decisions for the future, right? So there's a lagging factor here in the Fed decisions, but he did talk about a preemptive action, which also tells you he's looking at the labor market and thinking, okay, maybe it is softening. We need to pay attention to it. The other thing that he said was about the 2% target. If you remember a few weeks ago, I said the 2% target doesn't make any sense. It seems like they've pulled it out of thin air. We don't know where they came from. It's the same inflation target as they had before the pandemic. Circumstances have changed. Behind my statement really was this idea that the economy is trying to look for its own equilibrium. And the equilibrium may have been around 2% before the pandemic, but because of all the things that have changed since the pandemic, the equilibrium inflation rate for the economy, where it wants to settle, may be above 2%. What we learned was, this is Jerome Powell saying it, the 2% target, they're going to keep it because they're actually looking at it as experience-based. Not this equilibrium that the economy wants to settle at, but he views 2% as it's low enough not to be a hindrance to business decision making. Okay, so we're looking at it from being experience-based, that it's psychological. This is a very different way of looking at 2%. What if the economy doesn't want to settle at 2%? What if it wants to settle at 3%? Maybe that's the neutral rate, right? What happened to the neutral rate? So there are all sorts of questions that came up, but now I understand better why they want to settle at 2%. And it is maybe trying to fit a square peg into a round hole. We're going to get 2% because that's what makes people feel better. Interesting. But basically, that is a hawkish statement, but certainly he left the room open, or door open, for a 25-point basis cut. So the markets reacted very positively to that. We'll see what happens when we open on Monday. But certainly it left us with a positive performance for the week. Okay, so this week's topic that I want to dive into is really about the consumers. It's about you and me and the environment around us, and what the earnings from last week is telling us about how we behave, where we're shopping, what the environment looks like for homes, etc. So let me start with housing. I said I would cover this week, but I need to do it quickly because there's too many other things. Okay, let me give you some stats. National Association of Realtors gives us the median income for Americans. It's at $105,000. That's the latest reading. Just to give you a comparison, in December of 2019, before the pandemic began, that was at $82,000. So $82,000 to $105,000, that's a 28% increase during that time period. During the same time period, median existing home price, and I'm using existing homes because that's where most of the transactions happen, the latest reading was $422,000. Before the pandemic in December of 2019, that was at $275,000. That's a 54% increase in the same time period. So earnings have not kept up with home prices. And then add the increase in interest rates that we've all experienced since 2022, early 2022. Where that puts us, according to JP Morgan Chase, is that from 2019 to 2024, so this is a little bit of lagging data, but it's not very different. If you were to buy a home, you would have to spend 45% more of your disposable income on mortgage payments every month. That's a huge jump just in maybe 5 years. Okay. This is what is difficult about not only buying homes, but also if you have bought a home, about disposable income not being available to buy other things, especially when all the other prices have gone up since 2022. Okay. Now, just to give you a sense of what is happening and what has led up to this, let me back up to about 20 years, about 2005, when housing bubble was really still bubbling up and up and up and up. You could get a mortgage even if you couldn't prove that you had a job. Okay, that is how frothy it was and easy it was to buy a house and get a mortgage for 30 years. It was not the right thing to do. And of course, we all know what happened. The housing market burst, a bubble burst, and a lot of people lost their jobs, lost their homes, went into foreclosure. Home prices fell because, again, the housing market went into a tailspin. A lot of appraisers became gun shy about appraising and tend to err on the lower side. I remember this because I remember selling a home in 2010, early 2010. It was a very difficult time. A lot of people lost equity in their homes. And then, of course, there was a ripple effect throughout the financial markets. It was a very, very difficult time. So what happened was, even though the Fed reduced rates to near zero, a lot of home activity went down to historic lows, including construction. Home builders were very shy about building homes, especially spec homes. Like, sometimes home builders build homes and then you build it, they will come. There was not as much activity on that front. So between 2009 and 2020, so about 11 years, 12 years, we didn't build enough homes to keep up with the household formation. People still, grew up, got married and had children, needed homes. We didn't keep up. So what happened when the Fed lowered rates to zero again because of the pandemic, and we were all looking for more house because we were all stuck at home. We needed home offices because, working from home, and now hybrid is a thing. There weren't enough homes. Even at zero rates, people were, selling homes, not enough homes. So builders built a lot more homes at that time, but that period only lasted, 2.5 years, because the Fed started to raise rates very quickly starting in March of 2022. Okay. And not only did they start raising rates, they raised it by such a magnitude in such a short period of time. It was a shock to the system. So what did you do if you bought a home between 2020 and 2022, or you built a home, or you refinanced your mortgage to the lowest that you'll ever see, really, maybe hopefully ever see in American history, because if mortgage is that low and the Fed, cuts rates to zero, something is wrong, right? You were sitting on that mortgage. You weren't moving. If it's working for you, why move? Why give up the historically low interest rates on your mortgage, right? So what that did was actually no supplies came online. And because rates were really high again, home builders, now construction rates were super high, so construction activity also went down. We had another shortage of homes. And then, of course, rates went up. What people predicted would happen when Fed raised rates, that, home prices are going to fall because, there isn't going to be as much demand because the rates are high. That didn't happen because of that shortage. And it still exists today, okay? So this is the issue. Mortgage rates are high. Home prices continue to go up. It's starting to come down a little bit, but not by much. The median price is still at $422,000, right? So it's a really difficult time for first-time home buyers, especially. Okay, and we got some of that from the earnings last week. We had Lowe's reporting and Home Depot reporting, and both of those companies said that DIY activity has gone down because of the sluggishness in the housing market. Now, these two companies did really well during the pandemic because we were either improving our homes so that we could actually sell it, or we were improving our homes because we were home much more, or we were bored. Whatever might be the case, DIY activity was way up during the pandemic. Now that is actually correcting itself. Now, what's interesting is Lowe's and Home Depot actually had different corporate results, actually. Home Depot did not do as well. Lowe's did very, very well in terms of stock price movements after their reporting, but the message on the housing market is the same. So this is a very difficult environment for the consumers. And I don't think it's going to change anytime soon, because the Fed cutting rates by 25 basis points, what's that going to do, right? That's not going to make a huge difference in terms of affordability. And this is also what gets the White House is getting wrong about it on putting pressure on the Fed to cut rates, which, by the way, I do not endorse at all. The two should be independent. And by the way, the Fed reports to Congress anyway, so this is all noise. I don't know if you remember, but last fall when the Fed actually started cutting rates, mortgage rates went up. Because the mortgage rates, the benchmark rate is the 10-year yield. And that is much further out into the curve of the Treasury yield curve than the Fed rates, which are at the very, very shorter end. Maybe at some point we can go over the US Treasury curve, but yield curve, but it doesn't always move in the same direction at the same time. So I don't know what is going to happen, but I think this type of condition for the housing market and some of the challenges are going to persist for the time being. Okay, let's talk about other things that are impacting the consumers from the earnings report from both Walmart and Target. Walmart, and they both actually had an interesting quarter. Walmart actually missed its profit expectations. And this is kind of rare for Walmart. And we haven't seen that in, I believe, something like 3 or 4 years. But we did learn a lot from the earnings report. The missing the profit expectations wasn't from tariffs. So that was a phew. It was actually from, they had some litigation, and it was from some claims. So it was a one-time thing. I was looking for some tariff information, but actually the impact of tariffs, they said, was pretty low. So they didn't actually pass down anything, much of anything, to the consumer. So that's good news for us. And in fact, they raised full year guidance for 2025 and said that the consumers are pretty resilient. Well, of course, the consumers are resilient because they didn't pass down any price increases. But here's the other thing about Walmart. Walmart is considered to be sort of bellwether for the economy because they basically serve all Americans, basically all the average Americans. But what we've seen from Walmart in the last several years, this isn't just the quarter, but several years, and it's continuing, is that more people who were not spending money at Walmart before the pandemic or before inflation went up, they started actually spending more money at Walmart. So we're talking about people with higher income, higher earnings, buying groceries and other things at Walmart. So much so that Walmart actually created a new brand for, the people who like a little more upscale things. So that's actually a very interesting change. And Walmart continues to take market share from those consumers. So what Walmart is saying that consumers are resilient, I think, is because it is continuing to take market share from higher earners as they're looking for better ways to make their dollar stretch a little bit further, because everything is expensive, especially if you just bought a home with higher mortgage rates and higher home prices. You're going to need to make the remaining disposable income stretch a little bit further. So that was really good news for Walmart. And it does say something about us, right? We're looking for ways to save money. Target, it fell for different reasons. I think Target had less to say about all of us. It had more to do with their own internal strife. The stock fell. Their sales have been down. Also, they've been in the news a lot in the last several years. They're continuing to lose market share, unlike Walmart is gaining market share. even though they had pretty good earnings and the guidance wasn't any lower, it was actually pretty consistent. They did not have good news. And they also had some internal turnover in the executive suite, in the C-suite. And apparently the markets didn't appreciate it. So Target had a very Target-specific market reaction, whereas Walmart was able to give us a little bit more clue as to some of the things that we're looking for in these earnings reports. Tariffs, as well as what are we doing? Where are we shopping? All of these things. And the conclusion from Walmart's report is that, we're continuing to do what we did before, before the tariffs began. We were tightening our belts, making our dollars stretch further as inflation was eating into the purchasing power of our disposable income. And we're continuing to do that. And I think Walmart's positive guidance into rest of 2025, maybe if tariffs are coming in and impacting other areas and they're able to manage the tariff cost increases, if I were Walmart, I would continue to see increasing market share. I would continue to see new foot traffic coming in to purchase from Walmart, whether it be groceries or other types of items. So that says a lot about us too. So let's talk about what to expect this week. There's a lot, but I'm just going to mention a few things. One is on earnings. I'm just going to mention one company, that's NVIDIA. NVIDIA had a rough week last week, and part of it was the general tech sell-off. NVIDIA's valuations are indeed high. So there was that. But there's also some NVIDIA-specific news. And that is NVIDIA has asked its suppliers to actually halt the production of H20 chips. That's huge. And so let me back up and give you some context here. After the Trump administration approved sale of H20 chips to China, and NVIDIA stock rallied, and they said they would take 15% of the revenue, right? A few days later, news came out from China saying that China was basically telling their local tech companies not to use those H20 chips, but to use local or Chinese AI chips instead, and that would be Huawei. China said that they were afraid of some kind of backdoor for the United States to gain access to sensitive Chinese information through these chips, that there would be some kind of a backdoor in these AI chips. So they were basically telling their companies to use Huawei chips. This basically puts a wet towel on top of something that we were all very excited about the ability for NVIDIA to have access to the China market. We don't know exactly how this is all going to pan out, but certainly news of NVIDIA asking to stop the chip production was very big for NVIDIA. So there's a lot to listen for in this earnings report coming up. It's highly anticipated. Usually NVIDIA's earnings reports are highly anticipated anyway. But I think with the geopolitical mix up here, I think it'll be maybe more highly anticipated than previously. On the economic front, I'm just going to mention two things. There's a lot on housing, a lot of things on consumer sentiment, etc. But two things here: GDP for second quarter, second estimate. Remember, the first estimate was 3%. We'll see what the second estimate says. And we get the last inflation data of the Fed's favorite gauge, PCE estimate. I think it's on Friday. So that'll be the last print of PCE before the Fed meets in September. So it should have some clue as to what we think the Fed might do. It'll be very important. And by the way, before the Fed meets again, we have one more labor market report as well from the Bureau of Labor Statistics. So it's an important week. I feel like every week is an important week, but we shall see. And the weekend after this is Labor Day weekend. So I wish you a wonderful Labor Day weekend. I have not decided when I'm going to post next week's video, either Monday or Tuesday. I'll probably post it on Monday morning, even though it's Labor Day. I will be laboring in case you wanted to watch it. But certainly I don't think you'll be losing anything by waiting until Tuesday. So have a wonderful week, and we'll talk next week.